All right, so the backdoor Roth IRA is a big topic of interest and also confusion for big law attorneys, the niche that I work with in my financial planning practice. So let's talk about it. So what is it? It is a strategy for high income earners to get dollars into a Roth IRA account. Some high income earners are aware that you cannot contribute directly to a Roth IRA. And if you're aware of that, you may have heard that you can do what's called a backdoor Roth IRA, which is a workaround. Importantly, this is not a distinct type of account. So you don't call your broker or your financial planner and say, I need to open a backdoor Roth IRA account. They'll know what you're talking about, but that's really not the right terminology to use. It's not a separate type of account. It's just a strategy that you employ to get money into a Roth IRA account. So here's what you need. First, you need a pre-tax IRA, which is also known as a traditional IRA account. At some brokers, custodians, they won't have any qualifier name. They'll just call it an IRA. So if you see IRA, that implies that it's traditional and or it implies that it is a pre-tax account. Second, you need a Roth IRA account. So you're going to have two different accounts that you open to make this happen. And then third, you need a qualified tax advisor. I do not give tax advice. This is not tax advice. It's not investment advice. This is just education. You need a qualified tax advisor to make all this happen. And you need no or minimal other pre-tax IRA assets. So think about if you've left a prior job and you had a 401k and you took that 401k and you rolled it into an IRA. So you have like a rollover IRA somewhere. That can make this backdoor Roth IRA strategy really not appealing any longer. I'm going to touch on this concept. It's a thing called the pro rata rule. It has to do with the way that the Roth conversion or the backdoor Roth IRA is taxed. And essentially, the ideal situation is that you don't have any other pre-tax investment accounts. No other pre-tax IRA accounts. It's perfectly fine for you to have a 401k account at work. That doesn't apply here. But if you have a rollover IRA or another type of pre-tax IRA account, it really complicates this situation and generally makes it less attractive. All right, so we need to go over the rules of basically the traditional IRA and the Roth IRA to set the groundwork here. So for traditional IRA, what is often misunderstood is that you can contribute to a traditional IRA regardless of income. Some people might say or think that you can also make too much income to contribute to a traditional IRA, and that's not true. You can contribute. The issue is you lose the upfront tax deduction if your income is too high, and that makes it unattractive because then you're like, well, what's the point? If I can't get the upfront tax deduction, which is largely the benefit of doing a pre-tax / traditional IRA, why am I going to do it in the first place? The answer is you get some tax deferred growth along the way over time, but still it's just not that attractive. Also, if you were to contribute to the IRA and not get a tax deduction, later in life, currently age 75 for most people, depending on your age, you're forced to withdraw and pay taxes on the growth in the account later. So you can imagine you contribute to the IRA account, you don't get an upfront tax deduction. It does grow tax deferred over time, but then eventually later in your mid-70s, you're forced to take money out of the IRA and you have to pay taxes on the growth. So it just really waters down the benefit of the traditional IRA because you didn't get this upfront tax deduction. You're allowed to do it. It just isn't that attractive. For a Roth IRA, you cannot directly contribute if you are a high earner. I am purposely being vague about this because I'm making this video in 2023 and eventually the contribution limits, the earnings limits are all going to change and I don't want to have to make a new video. So you can Google, you can ask your tax advisor, which you should be doing, ask your financial planner, your advisor, what is the income limit, and actually it's usually a phase out for both deductibility of traditional IRA and contribution limits for Roth IRA. you cannot contribute directly at a certain point. There's no upfront tax deduction for a Roth IRA, but that's true. That's just true of all Roth IRAs. There's no upfront tax deduction. But remember, if you're a high income earner, you're not getting an upfront tax deduction for the traditional IRA anyway. So that's not really discounting the value of the Roth IRA in this context. What's nice about Roth IRAs is that you are never forced to take withdrawals under current law, and qualified withdrawals are tax-free. So that's pretty nice. So when you take these two things in context, that's when you get to the, I shouldn't have said context, when you take these two things in concert with each other and the features of each and the mechanics of each, you can start to develop a strategy to do what's called the Backdoor Roth IRA. So here is how you do it. Step one, you make a non-deductible contribution to a pre-tax / traditional IRA. You don't really have to say, I declare this as a non-deductible contribution. Just by virtue of your income, it either is deductible or it is not, or it's somewhere in between. There's a phase out in terms of your earnings where a portion of the contribution may be deductible. So you make a contribution to the traditional IRA, and let's just say for argument's case that your income is so high that you're beyond the phase out, you just straight up do not get a deduction for the contribution to the IRA. In and of itself, that makes it non-deductible. You don't have to like say this is a non-deductible contribution. It just is or it isn't. You make the contribution and then you wait. This once again is purposely vague. You need to talk to your competent qualified tax advisor to determine what your waiting period should be from the time that you make this contribution to when you go to step 3. There is a concept called the step transaction rule that you need to ask your tax advisor about. But essentially, there is a wait period, which is not official. There's no correct right answer to what that wait period is, but there is some sort of wait period that you should incur before you move from step 1 to step 2. After you've made the contribution that is non-deductible by virtue of your income, and you've waited whatever amount of time your tax advisor tells you to wait, step 3 is that you call your broker, you fill out a form, or you press a button. It just depends on your broker on how this happens, but there is usually just a pretty easy, simple step to make where you convert the dollars that you just put in your pre-tax IRA, or maybe you put them in there 6 months ago, depending on how long you waited. You convert those dollars that were in the pre-tax IRA to your Roth account. Because remember, you have two different accounts. You have a pre-tax traditional IRA account. That's where you made the contribution in step 1. You waited. Step 2 is you took those dollars and you converted them to the Roth account. And at that point, you have made the backdoor Roth IRA contribution, because conversions are perfectly allowed regardless of your income. It's just the direct contribution that is not allowed depending on your income for Roth IRA accounts. And then step 4, you need to file the appropriate tax paperwork to document the transaction. And this is really important that this gets done. So let's move on to that. Again, I do not give tax advice, and this is not tax advice. So here are some questions to ask your tax advisor. Step 1, should I be filing Form 8606 to document my non-deductible IRA contribution? Your tax advisor might tell you that this is an extremely important thing for you to do every single year that you make these contributions, so that there is a record of your non-deductible IRA contributions, which means you made contributions to your IRA, you did not get a tax break for those contributions, and you're building up what is called basis in your IRA, where it is tracked and easily viewed and known that you've already paid taxes on those dollars and you should not pay taxes on those dollars again later. Ask your tax advisor that. Second, very important. In fact, you should ask your tax advisor this before you do anything. Am I impacted by the pro rata rule? Again, I'm not going to dive into super deep detail other than to say the pro rata rule means that you cannot cherry pick one IRA account to convert and ignore other pre-tax IRA accounts that exist and avoid taxation on pre-tax dollars. From the IRS's perspective, if you have 10 separate pre-tax IRA accounts, they're all one single bucket of money. And so if you take money out of any of them, you are proportionally taking pre-tax dollars out of all of them. And this can really hurt you in taxes. And so you need to be hyper aware of this. Talk to your tax advisor about it. The way taxes work, if you're not impacted by the pro rata rule, you're generally going to pay taxes on the growth in the account between when you made the contribution and when you make the conversion. So let's say on January 1st, you contribute to an IRA, you make too much money, and so by virtue of your income, that is a non-deductible contribution. And then 6 months later, you convert those dollars to Roth IRA. During those 6 months, you've enjoyed tax-deferred growth on the account, assuming that the account increases in value. You weren't taxed on dividends, you weren't taxed on interest, you weren't taxed on growth in the account. And so there is a portion of the dollars in the account that have grown tax deferred. When you convert the account over to the Roth account, you're going to owe taxes on the growth. Hopefully, those taxes are minimal or de minimis. It'll depend on the value, what's happened in the account during the interim time period, the length of time you've waited between the contribution and the conversion. But generally, this is not a major deal. It's worth the hassle. If you are impacted by the pro rata rule, you're likely going to pay extra taxes that make this entire thing less valuable. It depends entirely on the size of the other IRA accounts. If you have $1,000 in a different IRA account somewhere, that's probably not going to be a big deal. If you have $100,000 in a rollover IRA account somewhere else, it's going to be a major deal. And so if you're impacted by the pro rata rule, it's probably going to be a problem for you. All right. So in summary, this is a strategy. It's not an account type. So if you call your broker, your advisor, and tell them you want to open a backdoor Roth IRA account, they're going to know what you're talking about, but it's not really the right way to talk about it. It's not a separate third type of account. You either have a pre-tax traditional IRA account or you have a Roth account, and backdoor is just the strategy to get money from one to the other. You need both a pre-tax and a Roth IRA, so 2 accounts. The way it happens is that you contribute to the pre-tax account, and then later you convert to the Roth account. You're going to pay taxes on growth between the contribution and the conversion, assuming there is growth. Usually that's not that big of a deal. And you're possibly going to pay a lot more in taxes if you have other pre-tax IRA assets because of the pro rata rule. At some point, we'll probably do a video on the pro rata rule, but for now, you have to consult a tax advisor. All right, hope this is helpful. Thank you.